All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it, YouTube, Spotify, all that. With me today, I'm excited to have one of the kings, princes, I don't know, of coal Twitter, Matt Warder. Matt, how's it going?
It goes pretty well. Thanks for having me on, man. I've been a long time listener, obviously first time guest here. So happy to talk to the community and field any questions you might have. Coal's a real passion project for me just in general. It's kind of where I started my career. And whether or not I've moved on to general space or broader metals and mining, I've always done some component of this. So the fact that it's at the front of mind for everyone here is just like really cool to me personally, and happy to get into the weeds with you as far as you want to go.
Well, you can tell it's front of mind because when I said you were coming on, you could see the response. You could see the enthusiasm about it. We're going to go into a lot of things, but I want to give two disclaimers before we get there. First, disclaimer to remind everyone that nothing on this podcast is investing advice. That's always true, but particularly true today. Matt and I, we were talking before the show. I think we hit 7 different coal companies inside of 10 seconds. So we're going to flip through a lot of different coal companies. Remember, some of these are international. Coal companies carries extra risk. International carries extra risk. Please consult a financial advisor. Remember, none of this is investing advice. So Matt, that out the way, the reason we're really talking today, I should have had you on a long time ago. I think if you look in your DMs like 2 years ago, it's kind of like, hey, but anyway, our friends at Range Global Resources introduced the coal ETF a few months ago. This is really funny because there used to be the ticker at the coal ETF is, good for them, coal. There used to be another coal ETF that closed, literally at the bottom, December 2020. Yeah. It shuts down. It would have been up like 25x. But if you wanted broad-based exposure to coal, there was no way to do it. If you were one of the crazy people who did. Our friends at Range Resources launched the coal ETF. They're like, hey, you guys should get together, talk about coal. There's a lot of interest. People are really interested in this. So that's what we're talking, the coal ETF. I just want to start. Look, I'm a generalist. I have friends who are all in on the coal trade. We can talk about the history. We can talk about everything. But just when people come to you and they say, what are your high-level thoughts on coal today? What are your high-level thoughts on coal today?
Well, so broadly speaking, coal, the hard thing that I think most generalists have with coal is that coal isn't just one thing. It's a spectrum of things, a spectrum of products that go across, utilities and industrial sectors. We send coal to power plants to produce power, obviously, and that's by and large what captures the headlines as far as the energy transition goes and how developed markets are looking to move beyond coal. That whole movement that's really geared toward thermal. There's another side of the business, which is metallurgical. Yeah, there's the other side of the business, which is metallurgical coal, which is used as the reductant to produce steel. If you can imagine, we heat up coal in the absence of oxygen, and it basically just makes carbon, like charcoal. And then that carbon gets layered into a coke, which is what it's called then. It's basically like charcoal. The carbon serves as the reductant to reduce FeO2, iron ore, into FeO. And as that melts, it has to trickle down through all the little nooks and crannies in this baseball-sized coke in order to get to the bottom, and then you tap it out. So those coals have very specific properties, mainly that when you heat them up to, a couple thousand degrees, they don't turn into dust. They turn into, charcoal, right? We also have industrial coals that there's a lot of high calorific value coal that is has very narrow specs and is used, for instance, to make cement. So you can use it to make cement, to make chemicals. There's a number of different processes it's used in, foundries for silicon. There are a number of different sort of industrial uses aside from just steel, but industrial coal is a much smaller part of the market. And for the most part today, we're going to be talking about, thermal versus met, the companies that are exposed to that, et cetera. But that's kind of the high level. If you haven't talked about coal before, those are the absolute must know things. And then to drill down onto the market side, broadly speaking, we're in a period where natural gas, which coal competes for in the power sector, is extremely low priced and is probably going lower internationally. We may get a bounce here domestically as some of that gas moves offshore into LNG. But in general, thermal coal is going to be probably lower priced over the next couple of years, at least. Whereas metallurgical coal, which is used to make steel, is far off of its highs, which were hit during the combination of COVID restarts plus the Ukraine war, beginning in February, March of 22. But now we're in this period where prices have kind of bottomed and stabilized at a much higher range than they are historically. And most of us who are analysts in the industry believe this is going to actually, follow through for a few years after this. So from an investing perspective over the next year or two, the metallurgical coal space looks much more stable than the thermal coal space. And I say the word stable, given that equities are off, 20, 30% here over the past few weeks because we entered into the shoulder season where not too many buyers are in the market. But, cyclicals do cyclical things, right? So what goes down eventually comes up when buyers come back in. In general, though, we think met coal markets are going to be more stable.
So you hit on a lot of things that I want to talk about, and a lot of really interesting things. But I just want to back up for a second, right? If I rewound to call it mid 2021 to early 2022, as I think our mutual friend, I won't say his name, but as multiple people point out, there were a lot of people on FinchWit in deep value forums who were very bullish the coal companies, right? And they were saying, hey, these guys are trading at fractions of a multiple, 1 times EBITDA, 2 times EBITDA. And they were saying global supplies are very tight. So yes, these are cyclical companies, I get it, but it won't take much to push them over the edge, right? And then 2022 was, people forget, it was a bad year for the stock market. It was an unbelievable year for commodities and especially for coal companies, right? And a lot of that was Russia-Ukraine war, right? That sends the shortages into a tailspin. And prices go parabolic. All these things. I mean, I'm looking at the chart of AMR that, it peaks at about 450 earlier this year. And I think it was trading into single digits in 2021, right? So all these things go crazy. I guess my first question I wanted to ask is, there's so much interest in coal Twitter, and that's because people good for them. They made a fortune in 2022. I think a lot of the interest stems from that history. And obviously the things are trading tighter, but just if I go back to that history, was that good analysis in 2021, 2022, or did they kind of get lucky, right? Like supply chains were a lot worse than we thought. Russia-Ukraine war, I don't think anybody was buying AMR in 2021 like, hey, Russia's going to go invade Ukraine. Like, how do you just kind of think of like the path that's gotten us here over the past 2 years? I know that's a weird question.
Right. Well, I mean, so the way that I kind of look at 2022 in particular, which is where everything peaked, is we got to see how sort of marginal unit economics kind of work in terms of supply versus demand, right? When you run out of available material on your cost curve, what are end users willing to pay for that marginal ton? In this case, for met coal and thermal coal, they both got up around $500, $600. I think met coal topped about 620 or somewhere around there. I mean, just ridiculous numbers. But the bottom line is we were in this period where, Russia had been sanctioned, so they could no longer sell coal into Europe. So it took about 6 months for, the musical chairs of trade flows to readjust. And during that period where coal was unavailable, that's what shot it to the moon. Now, why the equities, have been able to follow through on that is because they have, periodic contracts that reflect what those spot markets are. So if you sell ahead, you sell generally like 3 months, 6 months ahead. So when the price was at, 622 and the bare minimum of analysts are covering the space, I mean, we really have just 2 or 3, analysts that cover the coal space. Everybody was behind the curve in realizing that, that massive amount of cash that they booked in Q2 wasn't going to actually hit their, revenue until Q3, Q4. It's going to come out over time and look like a pig going through a python. So the analysis was right, but the equity peak does not coincide with necessarily the price peak. So that's part one of that.
If I can just add,
we were mostly right.
If I can just, the other thing think, like, no one can predict Russia-Ukraine, but what you can do is you can look and say, oh my God, these markets are really tight, right? If there's 100 of demand and there's 100 of supply and there's 0 more supply, so I'm almost buying a free option, right? Like if one negative thing happens and we go from 100 in supply to 99 in supply, we're going parabolic, right? And you don't know what the match that lights the dynamite is. This wasn't just a match that lit the dynamite. This was dynamite that lit dynamite. But you just say, hey, like, I'm getting a free option where these are really cheap. This dynamic is in play. And we all know something bad happens eventually to these supply chains, and there's just no more supply. So I think it was great analysis. I do look back and I say, hey, it was really aided by something, but please continue. Oops, Matt,
yeah. So that's that period. Yeah, it's okay. My internet connection is a little wonky here, so if it cuts out or whatever, we can
look, your internet, it's powered by coal. That's the issue. It's powered by coal.
That's right. Yeah, unfortunately, I think that not enough coal power to get through 3 walls here to the office for the time being. When we move on to the next phase, so companies have got this giant windfall of money, right? This giant pile of money. And they all pretty much did the responsible thing with it, which was pay off their debt. And after you paid off your debt and you still have, this historically massive amounts of free cash flow left, there's not much left to do with the money unless you want to grow production. There are a few companies that are doing that, or you want to give the money back to your shareholders. And with coal not able to access finance as readily as they used to, the amount of growth that's out there is just not really existed. There are a handful of projects in the met space. There's really not much at all in terms of thermal coal. So we wind up in these periods during the cycle where, because the moving away from coal has been dictated from the top down by political bodies in the Western world. When we go through those periods like we had in COVID, where prices go, oil went negative, coal went, to double digits for met coal, which is, we hadn't seen in years. But when that happens, mines shut down. And when they shut down, particularly in the US, these developed markets, they don't come back. So when demand eventually swings the other direction, like the United States used to be the swing supplier to the entire world. And now we're not physically really able to do that anymore. And that's the dynamic, I think, that people sort of maybe miss or don't understand. If let's say coal is a dying commodity, well, commodities don't die down, they die up. And that's how you incentivize, further transition and those sorts of things. But we're probably in the third inning of this part of the cycle.
That's really interesting.
We're going to have another.
I like that quote. I don't disagree with it. The quote, commodities don't die down, they die up. Can we just, so what you mean is what happens is the prices, because you've got some legacy use, and tell me if I'm wrong, you've got some legacy users that can't transition away for XYZ reason. Commodities die up, meaning the prices just keep going up, 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 up. And, it's not oil goes from 100 to 10 because no one's using it. It's oil goes from 100 to 1,000 and it keeps going up until people are disincentivized from using it completely is what you're saying.
Right. Because the supply goes away and it is not incentivized to come back, or in the case of coal, it's prevented to come back largely from lack of access to finance. So, we're in the midst of a down cycle now in thermal coal. So if you're long thermal coal, which, I don't necessarily want to be, or at least not overweight to it at this point in time, you want to be long the lowest cost producers because those are the ones who are going to be able to weather the storm. And really we're in the quiet period for metallurgical coal. Steel is a very lumpy business, as are utilities. Obviously, utilities are stocking up when demand goes down so that they can, get their stockpiles ready for summer when they need to really dispatch. And likewise, steel companies only buy a couple times a year. They buy, basically like call it late July, early August through October, and then they buy like late November, early December through February, March, the period that we're just in. And the spot prices in the middle of those times tend to go down unless acted upon by some outside force or we have a supply disruption, those sorts of things. So to move on to sort of thinking about the period now we're in a more mature period where, equity prices are going to, capture probably more of the beta of fluctuations in prices than they normally would. This is a very different environment from 21, 22, where the path to, re-rating was really, really clear. Now, a lot of these companies have re-rated. Some of them need to re-rate more. And, but Others are re-rating through like their buyback programs like AMR is. And all of this is going to take a number of years to play out. I tend to think of like, a good coal cycle lasts about for 5 years. And in those 5 years, you have one really bad year and one really, really good year. And the other three are sort of average. And the two things I think are changing are the bad year is going to be higher, the low year is going to be higher, and the average over that period of time, I think, is going to be markedly higher for met coal. For thermal's more at the mercy of natural gas. And my track record of predicting natural gas prices is unblemished by success, shall we say? So
I like that.
I'm more of a data yeah. Well, it's borrowing that from Rick Rule, but on the gas side, I tend to be more of a data consumer than a generator of it, and I rely on a lot of people's outside views to sort of guide me through how I need to be thinking about thermal coal markets, because it really is a direct competition between one and the other.
Can I just pause you there? So a lot of the questions, and this is a question I had as well, right? It was going to be, hey, nat gas is really down, and nat gas and coal compete with each other, right? Plants are always running, hey, what's our best source? They'd probably rather, all else equal, they'd probably rather run nat gas than coal just because nat gas is cleaner. You've got to incentivize them to run nat gas, and there's other stuff going on. But a lot of people were sending in questions like, hey, nat gas is basically free in Texas right now, and the Biden administration wants to kill coal. There was an article that came out Friday afternoon that said the Biden administration, I think the quote was, it wants to kill coal, right? And I think the article was a little overblown. It said, hey, if you're not installing cleaners on your coal plant, we're going to shut you down by 2040. But they clearly do not like coal. A lot of people were saying, isn't this a doomsday combo for coal? And I guess maybe not. But what you're saying is investors, they can go look at coal. Might be interesting, might not be. You probably need to think a lot about international demand. You're much more focused on metallurgical coal, and you think that's where the real interesting stuff is happening right now. Am I putting words in your mouth, or how would you respond to that?
No, for the next couple of years, I think that's right. But the same way I was talking about, all of the coal industry during COVID, how there were mines that shut down and didn't come back, and then when demand creeped up to the upside, there wasn't any coal available, and prices went to the moon. The thermal coal market is setting, especially domestically, is setting itself up for that again. To the comment about Biden and there are regulations at EPA, for instance, that are being proposed for, I think it's for SOx and NOx emissions,
that's right.
Sulfur dioxide and nitrogen oxide, and for Western plants, unless they retrofitted, which is economically unsound, that would pull forward retirement for like 40 gigawatts or something like that of coal-fired power plants, which is a lot. And thinking back, the winter storm in Texas, that's all of those coal plants which were needed in order to provide backup for that 6 Sigma weather event that happened down. So, like, ironically, at the same time that the Biden administration is putting forth this messaging, which, by the way, is in an election year, so this is not really. It's not really that uncommon for liberal-minded Western people to, propose
You shut down the coal industry and you lose the West Virginia vote by 55 points instead of 50. Like, what's
that's right?
Can I ask you a question? One question on coal. Look, in my mind, I used to cover utilities pretty closely. Coal is generally baseload, right? Not peaker. Would coal have now? If the whole thing had been, if all the Texas power plants had been coal, yeah, it would have really helped in that freeze. But would coal, having a little bit more coal, really have helped that freeze? Because it's not like coals are peaker, so you could just all of a sudden brought them back online in Texas.
Well, you can import power, so you can generate power in other states and then import it down to Texas on an emergency basis. But those plants were really low on stockpiles. And that was really obvious that summer, starting in May. I started a contract for filling in for a friend at my old stomping grounds at Wood Mackenzie to model U.S. domestic thermal coal prices. And I looked at the stockpile levels and just kind of went, "Ooh, we don't have enough relative to production." Rail was still, we were still getting people back to work for rail. The offices, people weren't in the offices and all those sorts of things. But it was pretty clear that there was a problem. I think I remember looking at the amount of burn for coal that their gas team had used, and it was something like 30% more than the fleet was even capable of providing. And they'd done that to balance out their natural gas forecast, because coal is one of the variables that you can adjust in order to arrive at the conclusion that you're looking to get. Well, nobody had sort of informed them that, like, well, you actually can't do that. And when they made those adjustments, you got these really ridiculous power prices, which wound up being true. So yeah,
all I'm hearing is we should have gone long ERCOT futures. That's what we needed to do.
Yeah, but it was a really scary setup in 21. We're past that, but my sort of caution is that if any of these sorts of regulations wind up taking place, and I think we're going to have a lot of domestic mine shutdowns just due to price itself. When those go away, they're not coming back. They're not going to be available for domestic markets or for export markets or for anything. And there's one thing we know about the energy transitions, that storage at scale is not going to be here for 30, 40, 50 years. It's going to be a long, long time before we see it. And until then, you can't just build out renewables, because renewables aren't dispatchable. You need baseload dispatchable power to balance the grid. Could you redesign the grid? Sure. But now we're getting into a whole other can of worms. So just, you can't go from step 1 to step 40. You have to go from step 1 to step 2 to step 3 and make your way gradually. And yeah, that's the problem, is that we're trying to solve the energy transition through sound bites, and that just doesn't work in practice.
Hand in hand, I found hand in hand with the coal trade is the uranium trade, right? Like they go 100%. Hand in hand. It's not a coincident range resource launch, a coal and a uranium ETF, but they go hand in hand. And I'm with you, right? Like we're shutting down all these nukes, which are clean baseload power, and it's completely insane to me. Anyway, 100%. Let me put that aside. So if I'm hearing our conversation correctly, like there can be opportunity anywhere, right? Like these guys still trade with very low multiples. They've all gotten pretty good religion on buying back stock. But what I'm hearing from you is more, hey, you can YOLO a thermal coal play, might work out, might not. Probably you got pretty good trends in your friend, and you might have a really super normal profit year. But met coal seems more interesting to you. I want to talk about a little bit more about why met coal, but most of my audience is generalists, right? Most of them aren't crazy coal people. If I just looked at the domestic companies, right? There's Alpha Metallurgical Coal, AMR. That's the one that if you pull up a chart, that's the one the Wall Street Journal is going to show. Look at how well these coal companies do. There's Arch, there's Warrior Met Coal, there's CIX, Consol Energy. There's a few other who I'm missing off the top of my head. But if a generalist is listening to us and they're like, all right, Matt sounds smart, sounds like met coal is where I really need to do the ramp up. What are the domestically traded coal stocks that they should really be thinking of that lean met coal versus thermal? Because again, it's in some of their names, but it's not completely obvious. And these things it's very tough to ramp up on a completely new sector, especially one. It seems simple, but it's tough. So which are the ones they should really be focused on, do you think?
Okay, on the met coal side, Alpha Metallurgical Resources is a pure play metallurgical coal company. Warrior Met Coal, ticker HCC, is a pure play metallurgical coal company. Ramaco Resources, METC, is a pure play metallurgical company. And as you start moving into Arch and Peabody, and then if we wanted to include the Australians, the Whitehavens of the world, those become sort of hybrid to varying degrees. Arch is mostly met coal. From a revenue perspective, but they do have very large mine in the Powder River Basin, which produces 70-some million tons a year at like $1 margin or something like that. So it's not really contributing that much to the bottom line. And there are and obviously the regulatory risks of Western plants that I just talked about are an issue. But they get 90% of their revenue from the met coal side, so they're really more a met producer. Peabody and Whitehaven with the acquisition are getting more into the 50-50 territory now. And those companies, sort of broadly speaking, are all generally fine to hold through the cycle. They're all going to have, varying degrees of success or volatility with regard to price beta. But, the one thing I would caution investors now is like the big move is done. Like that's in the past. That's in the rear view. There are a lot of companies that still do need to re-rate. They're going to do that organically through buybacks. But, I think more about the space right now as kind of like, they're kind of grandpa stocks now, right? Like utilities used to be back in the old days. pay a 5-6% dividend or something like that. I mean, most of these companies, especially on the met side, are going to generate any year somewhere between, let's call it 8 to 10% on the low end of free cash flow. And during a boom year would be like 50, 60, 100% in a year where prices go bananas. So, you're really buying it for the yield, free cash flow yield at this point in time. And you're buying it for management's willingness to return that free cash flow back to shareholders rather than, do other things with it. That's largely why, the thesis behind why we're invested in the space at the moment.
I just think it's funny you say they're largely grandpa stocks, because I understand what you're saying. Like these are return of capital stories, right? Like what 100%. You want is all of these guys, and they appear for the most part to have gotten religion. I know one who we might mention, who I know a lot of shareholders who really want them to get religion, but
sure,
you guys are going to generate a ton of capital. This is a sunset industry, but guess what? It can be a beautiful sunset. You just buy back your stock, return it to shareholders, 20% yields. And as you said, these things tend to die up. It tends to take a lot longer to divorce yourself from these energy sources than you think. So you can generate 20% returns for a long time. Exactly. I guess let's start met coal, right? One question I frequently get: what is the global cost curve for met coal? Because it's probably changed a lot over the past few years. As you said, some mines have gone offline. There's been a lot of inflation across the board. You name it, and what you want inflation. I think people are really questioning, hey, when I'm trying to establish kind of normalized earnings for one of these players, where do I start looking at global cost curve so I can start determining where my company sits on it?
That's a good point. And, at least from the little bit of research that I've seen, I don't think that the global research industry has done a real good job updating costs from year to year. The biggest things that have happened just in terms of that, and I came up as a cost analyst, right? So I did, mine level estimates of what cost was going to be. I built up cost curves. I built Wood Mackenzie's coal coverage for Appalachia, which includes all of the metallurgical coal production in the U.S. at the asset level. So this is my thing. This is my bailiwick. The two things people have to realize are that labor inflation has gone absolutely bonkers to the upside. It's hard to get, because the industry has been so volatile in the past. It is really dramatically hard to attract labor, much less keep it. So producers now, like I was driving to see Alpha Metallurgical Resources operations in West Virginia last year. And we saw billboards for advertising for Warrior Met Coal is hiring in Alabama. That's how competitive, the game has been. Alpha has this great recruiting video that they put out on local TV now. It's fantastic. It's like, it wasn't Sam Elliott, but it's like Sam Elliott overdubbed it. It's really well produced. They're doing everything that they can to attract labor. And then moreover, they're trying to do all they can to take care of it from here on out. And that's an underappreciated aspect of the market. The other thing is productivity, especially in the U.S., but also in Australia now. Generally, it doesn't go up over time; it goes down. So not only are you spending more for labor, but you're mining less efficiently over time. And remember, there aren't any new mines, so what you see is what you get with regard to productivity.
Are we mining less efficiently because kind of with oil, we've already tapped the easy oil field, so we're starting to get. Is it, hey, we've already tapped the easy met coal, so we're getting into harder, or is it because hey, the labor? I could also imagine, hey, the labor force is aging. When you've got all your labor forces 30 to 40-year-old men mining, they're going to mine a little bit faster. Now, I know there's machines and stuff, but they're going to mine a little bit faster than when all your labor force is 50 to 60. Is it both? Is it yes and? Is it more one than the other?
I mean, it's mostly incentivizing people to just come into the industry. In West Virginia, where I grew up, coal mining is one of the few jobs you could do and make six figures and not have a college degree. It's not the case if you want to be, an engineer, or you want to be, electrician or something like that. You either have to have professional certificates or college degree. But if you just want to go run coal, you can do that and make a great living in a place where it doesn't cost that much to live and have a really, nice life. And if you think about the economic benefits for, the surrounding communities, well, those high-paying jobs without college degrees are what supports all the local restaurants and car dealerships and convenience stores and body shops and that sort of stuff. And I think people, certainly politicians, have discounted the second and third order economic effects of those jobs in those communities in the past, and that's much to my chagrin, even as probably one of the few, if only maybe the only liberal guy in the coal industry, right? Those things are concerning to me because those are my people, where I come from. I don't want to see them, have to suffer. And if you think about their wives are teachers, that and if they have to move to find work, then you have to. We have this huge labor problem in teaching in West Virginia too. There are lots of other unintended consequences that come from, kind of selectively pushing down on a lot of those jobs. Getting off on a soapbox a little bit here.
You are. But I don't disagree, and this is why. Yeah. This is why if you're elected from these communities, it's like job number one. You go in and you let them know, hey, I don't care about everything else. Like, we're protecting this community. We need to keep it open, and there's a lot of reasons for security. But I do want to go back to the question I had. Yeah. But global cost break even for met coal.
So the labor inflation has been enormous, and a lot of those issues are at the root cause. Like, incentivizing people to come in has been difficult. The other part of it, Australia has been legislative. Queensland changed the royalty regime from, as high as, 25, 30% up to it goes up to 60 when prices get that big. So the cost curve now looks dramatically different at 200 prices than it does at 400 prices. And that, I think, is probably where we're going to be range bound for a long time. The methodology that we used at Wood Mackenzie to kind of figure out what long-term prices are is basically like the 90th percentile cost. So that's a pretty good proxy for where the average is going to settle out for a long time. Unfortunately, it's over the past 10 years, it's proven really not to be true at all. The 90th percentile cost for years was like $150 US. And that's what, all the banks would put in their decks. That's what we always had, was 150, 155. Somewhere around in there, and it came out to that pretty much every year. You could set your watch by it. Now that number has crept up a lot. Labor is probably, I want to say, 40% more expensive than it was, 10 years ago. Productivity in Central Appalachia is down really significantly over that time. And not only is productivity down, but recovery at prep plants, like, the thinner the seams go, the more rock you have to mine, and your recovery can go from 50, 40% like it was back in the day down to, some of these thin seam mines in West Virginia is like 25%. So you're mining 75% rock. You're not getting as much coal out of the ground, and your labor cost has gone up. So you tack on, taxes on top of that, and you've got a real, fundamental inflationary problem sitting on the cost side. So, the 90th percentile costs, looking backwards from, call it 2008 to 1998, was pretty good. It was a great methodology. Since then, we've had so many supply problems in Australia that have forced the met coal price up to $300, every few years, whether it's a flood or whether it's an outage or something like that. If you look at the average coal price over the past decade, it's about $270. And that is not necessarily congruent with, the long-term price or the 90th percentile cost. But if I had to guess right now, easy way to do it is just, let's take Alpha as a proxy. They've reported their costs at about $110, $115 at the mine gate per short ton. It costs about $50 to get it to the port. So let's take the top end of that, just for argument's sake. Let's get it to the port. That's $165 per short ton. Okay. So if we move that up to metric, that'd be $180. So already we're $30 above where the old long-term price was. And that's with the most important met coal company in the U.S. That right there is a signal that top line number is up.
Most important, I think they're maybe not the lowest cost, but they're a lower cost producer. And the math you just did was that doesn't give them a return on their investment, right? That's their cash break even cost. These guys need a return on their investment. So let's say the cost of capital for coal is 20%, whatever. In my mind, you say 180, you add some SG&A, you add a cost of capital. I think obviously they can sell at cash cost for a little bit in a downturn, but I think kind of you're starting to talk about the global break even is in the 240 range, if I'm thinking about that incorrectly in my head.
If we follow on your comment there, let's add in sustaining capex. That's about $10 a ton in Central App. That gets us from 165 to 175. If you want to add in SGA and taxes, that's about another $5 a piece. That gets us from 175 to 185. So now if we convert to metric tons, that becomes 203. All right. So 203, and how much profit did you say? We want a 20%.
I was saying return on capital 20%. That's not directly congruent with margin, but yeah.
243 then. That's what the long-term price needs to be to ensure that there's going to be enough production to service the steel industry. Like that's the math.
Let me flip to a completely different one because I think it's a really good question and it's one I'm not a coal expert, but 10 years ago when I heard people talk about coal, I would hear a lot of people talk about metallurgical, and they'd be like, the great thing about it is you really can't green around metallurgical, right? You really, if you want coal to cost $500 kajillion per ton, sure, you could do something, but you really need the metallurgical coal in the process. There's no way around it. Now you're starting to see some green peels, and I just want to ask, what is the future of metallurgical steel making, this greening look like, right? Is it an opportunity? Is it a concern? Is it a risk? I'd love to hear your thoughts on that.
Yeah, so it's a complicated question because when we really talk about the energy transition or the green movement in steel, we're really just talking about the United States and Europe. I mean, that's really it. Japan's not really going to do it to any degree over the next 10 years. Southeast Asia really isn't. China certainly isn't. And India is growing. They're growing their blast furnace production. So, the declines that we'll see, and there will be some, in the United States and Europe. For instance, in the U.S., both the Canadian operations up there, Stelco is going to convert. Algoma is going to convert from blast furnace to electric arc furnace. Dofasco, ArcelorMittal is going to convert from blast furnace to electric arc furnace. Those are all happening within the next 3 to 4 years. That's already sort of on the books. It's about 3 or 4 million tons of steel demand or of coal demand. It's not a whole lot, and we know about that. In Europe, it's a little bit different story. Like in the U.S., we have this really well-developed scrap market that's been around for decades, right? Because you have to, if you're going to transition to EAF, you have to melt scrap. Europe doesn't really have that kind of developed scrap market like we do. So they're going to have to import. And if your iron units for scrap become higher cost because of that increase in demand relative to your iron units for a blast furnace, then you got a problem. So
can I just back up? Because again, I'm a journalist. I understand most of what you're saying, but some of the words you're throwing out, even I don't know. And I think a real generalist might listen in and be like, what the heck's going on? So let's just back up a second. Blast furnace is your traditional steel making process. You toss in a lot of heat, a lot of coal, and you get steel out. The electrification way would be going with an electric furnace. Can you just tell how is that different? And I think that'll help explain why the scrap steel prices you're talking about make such a difference.
Well, I mean, an electric arc furnace takes scrap steel and it melts it in a big ladle with 2 electrodes that come in from either side. There's a lot of other smelters that sort of operate in the same way. That's the one we do for steel. You can take used steel and re-strengthen it. Nucor's done a great job with that in the U.S., for instance. But there's still, I mean, we have such high safety standards in the U.S. for automobiles that we still need to, custom make a lot of virgin steel in order to supply that demand. Similarly, there's a lot of high tensile strength steel, in plate that's going to be hard to manufacture without coal. But out, in Canada, they'll manage to do it a little bit. And then, the other thing I think is, I started talking about how Europe doesn't have a developed scrap market. And because of that, they'll have to import a lot, which could send the prices higher, right? So blast furnaces use coal, electric arc furnaces don't. If the scrap price goes too high, Europe is going to need to have more blast furnace production. They're going to have to optimize those two components. And so, I think what happens in Europe over time is instead of transitioning those blast furnaces over to EAFs that are using, instead of scrap, they were proposing to use direct reduced iron as a iron input. Direct reduced iron is either reduced with natural gas, which is available, or the green way is with hydrogen, which isn't available yet. So two avenues by which you could make sort of zero carbon steel or low carbon steel if you move to the DRI EAF part. Well, problem with that is we don't have a whole lot of DRI pellet capacity either. So there's going to be a competition for the iron units either way. And so I think what's going to happen, the government's going to pay for these EAFs. I think French government's paying for about half of ArcelorMittal's conversion from blast furnace to electric arc furnace at Dunkirk and Fos-sur-Mer in France. I think the German government wants to pay for ostensibly all of ThyssenKrupp's conversion of Duisburg from a blast furnace that uses coal to an electric arc furnace that doesn't. But I think what's going to wind up happening is that both facilities will just exist at the outset of this, and steel producers will have to optimize both of these assets now in order to meet their downstream demand. So I think instead of like just switching it out one for the other, like Canada's going to do, and probably have some success at, in Europe, I think it's going to be more sort of a trickle, and it'll be a more gradual process over time. I mean, it's going to take 15, 20 years to build a hydrogen infrastructure network over there alone. So I don't even think they can get there. And that's before we get into the questions about whether or not hydrogen is safe to use in a high heat setting. Because molten metal and water do not get along particularly well from a chemical perspective. Water plus molten steel equals boom. So, I know I've talked to operators who have kind of safety concerns about, pushing that movement too fast. So I think that part of the transition is going to be more gradual than people expect, if that makes sense.
No, it makes total sense. I'm just laughing the first part where you talked about, hey, they're doing all these electric arc furnaces and they're going to have to find the balance between blast and electric arc. You could very easily imagine a story of like regulatory oversight gone wrong, where it's like, hey, we electrified the whole European steel industry. It's great. And what actually happens is they blast furnace it in India, China, name your low cost market. They just take all that steel that they blast furnace, bring it in, and then they put it into an electric arc furnace. Like I could imagine some crazy story gone wrong of that.
Which will be powered by coal.
Yeah, exactly. Let's see. Lots to talk about. I think we hit the green. Let's go to, there are a couple companies specific companies we've mentioned. AMR,
okay,
War Metallurgical, HCC, BTU, all of them have interesting angles to it. Let's take one or two and just talk about what you're hearing from investors, how you're thinking about it. I'll let you start. Like, what do you think the most interesting of these larger, let's stick domestic coal plays is to talk about right now?
Okay, so what I would generally say, just from the outset, and I better probably put on my AMR hat to do this.
There we go.
Right,
you've got your AMR sweatshirt on too, so now you're a real AMR man.
Right. So the AMR has already paid off their debt. They're in the midst of a buyback. They're going to be profitable for a long time. I talked about the resilience of what I think the coal price is going to be relative to costs, and I think we're moving into this area where producers are going to be much more responsive to changes in price. So I do think we'll see, announcements of production cutbacks and things like that as prices go lower. And we're in the shoulder season now. AMR is trading below, are they below 300 today? They're not. They're at 305. But over the course of the next couple of months, if prices come down a lot, we could see, AMR trade down around, $250, $265, somewhere around in that area. And that to me would be a big screaming, buy signal. Like this is a good place to sort of establish a.
Well, why 250? Let me just ask why 250, right? We picked a number. Obviously, everybody would like a 20% discount on their stock, but what is it about 250 that says, hey, this is the level for AMR where it's really interesting?
Probably easier to show than to tell. But if you looked at a chart, of AMR from say like 2020 until present, we had a run up in 21 and 22 up to around the $150 per ton, $150 per share level. And then we kind of went sideways as the buyback chewed through, 30% or so of their float. And then by the time that we got to the next year and they report earnings, on that year-on-year comp, the share count had gotten so low that estimates were incredibly light. And so they basically engineered their re-rate through last year's, reporting. So the stock price went from that 150 level basically up to, $250 pretty quickly from, I want to say from May, from like May of 23 up through September, October, went straight from 150 to 250 and then corrected back down to like 218. But that's the range where I think if the markets go in the doldrums that we could correct back down and test to in the short term. And, if that does, then it's time to sort of jump back in.
So let me ask. So right now, AMR is at about 300, right? That gives them an EV. I'm just looking at Bloomberg. I don't have my full model pulled up. That gives them an EV just under $4 billion. And I'm seeing about 700 million in EBITDA estimates for this year. So let's call it 5 to 6 times EBITDA estimates. Yeah. If I looked at it at your level that you're talking about, that's down 20%. So now we're talking 4 to 5 times EBITDA estimates. Yeah. Let's stick with AMR for now. Mm-hmm. Let's say I'm right, roughly those maths. 5 times EBITDA now, 4 times is where your buy level. Why is that 4 times EBITDA the buy level for you, right? Like we can talk about free cash flow. Do you think this EBITDA is this year's EBITDA depressed, so it's going up? Like what is it about that number that screams fundamental value?
The fact that they bought back 40% of the float, and that number is just going to keep going up as long as they keep on keeping on with the buyback. So valuation for AMR is approaching arbitrary levels here. When you get to the point where you're not only cannibalizing your own shares the way that they've been doing for the past couple of years, but then you also have perhaps some price appreciation. The big value add from this last cycle up was like if you looked at their registry, you'd see Renaissance Technologies and the momentum algorithms, which had really glommed onto basic materials and particularly the small cap, mid cap variety as the market sort of melted up from October through here a couple of months ago.
I think what I'm hearing is, look, every value investor decries, hey, I've got a company that sells widgets and there's a competitor that sells widgets. The competitor's in the S&P 500 and my company's not. And the competitor trades for 3 times the multiple and it just keeps going higher. And guess what? That's because they have the index flows. And what you're saying is AMR's bigger. They've squeezed their stock and they keep buying back more and more and more. So they get the benefits of momentum. And again, it's not like we're talking about paying through the nose for multiple here. Let me provide a slight pushback. When I talk to my friends, and we've got a lot of mutual friends, I think several of the ones I'm thinking of here, and including some who I texted to prep. Warrior Met Coal, HCC, is the one I keep hearing. And the 2 things I hear from them are, hey, we're playing 2x EBITDA cheaper for Warrior Met Coal, probably similar-ish asset quality. Mm-hmm. And why can't Warrior Met Coal AMR themselves, right? Yes, they haven't done it yet, but look at the cash flow and we can talk about Blue Creek. They've got this big Blue Creek mine. Again, I know shareholders who want to go in with the proverbial shotgun and say, you can do Blue Creek and a buyback at the same time, but they're saying, just look out 2 years. Blue Creek's going to be a great project and then they can start buying back their stock. And yeah, we have to wait a year or 2, but we're going to get AMR'd eventually in Warrior Met Coal. So I threw out a crazy amount at you, but I'll just toss it over to you to respond to those feelers.
That's right. I mean, that was going to be the second equity I talked about anyway, right? Because the way I sort of look at it, if you're going to invest in coal, you have to have 2 barbells kind of on either side. One on the buyback and one on the growth side. To me, they're horses and courses. AMR is further along in their buyback process than is Warrior, but we know what the path is. I think is more to the point, right? And I think Warrior has kind of been, let's say, unjustly punished here over the past few sessions. Partially because they haven't really committed to a buyback, and they're a little bearish, on their calls. But I venture to guess, and my friend Koala has talked about it on Twitter a couple of times, where he's mentioned that if Walt and Dale would just sit on a call like, look, we get your emails, we know everybody wants a buyback, but like we're in charge of delivering this project, which is going to add the ability to do that. We need to make sure that this goes off without a hitch so that we can turbocharge, a shareholder return program after the fact. But if this mine doesn't get here, then, whatever program it is we decide to do is going to be, lackluster in comparison. I think if they just said that to the masses, then people go, all right, fine. Okay, that's cool.
The mine that you're talking about is Blue Creek, and I think they're putting in over $1 billion. I can't remember the exact numbers into the Blue Creek. But do you think Blue Creek is going to be a successful project in terms of, forget if they produce coal, is it going to deliver an attractive return on investment for that huge amount of money they're spending into it?
Oh, yeah. It's a needed quality in the world. For metallurgical coal, and this needs some context as well, because this isn't something generalists are going to know. We rate thermal coal based on heat content, in BTUs or in kilocalories. So you have really low, heat coal like Indonesian coal at 4,200 kcals. You have really high heat coal like U.S. coals, which are, call it 7,000 kcals, 8,000 kcals, about twice as much or more in terms of heat content than Indonesia. On the metallurgical coal side, we value the products by rank, and one of the ways that we measure that is with a volatile content. So, like if you imagine coal is 100%, a low volatile coal will have 20% that of its composition that is like not carbon, and a high volatile coal will have like 35% of its composition that is not carbon. So back in the day, way back when, that 15% delta is also played out in price usually, because you're trying to hit a blend sort of in the middle. Like the steel industry was built on mid-volatile coal, but we don't have too much of that in the United States, so we started having to mix qualities and start this whole process. Europe does that too. Now, the quality that Blue Creek is going to produce is a really top quality high vol that shrinks in coke ovens when you put it in. So you can now, that allows coke makers to use a wider variety of low volatile coals that may expand, that are a little bit cheaper. So it allows them to sort of keep their cost in. And there hasn't been enough of that type of coal in the market for years, to the point where, like, one of the most well-received papers I wrote at Wood Mackenzie was talked about what we called at the time crossover coal, which is high volatile B coal now, the B grade coals. Those are a little bit lower rank. They don't coke quite as well, but you can use them in 10-15% of the blend. That came into the market, got pulled out of the thermal coal market, got put into the met market, and it's there now. The more high volatile A production we bring on, the less B production we'll need. So coke strength is going to get more strong over time. With the advent of that coal. So it's going to be in really, really high demand regardless. And probably the losers on the other side of the situation, may come out of the market during this downturn, which are people who produce mostly thermal coal with a little bit of met or something like that. So there will be a balance in the market. That coal is really needed. It'll fetch a really good price. Just from a free cash flow perspective, like even at pretty bearish long-term outlooks for Blue Creek, Warrior's going to, free cash flow $600-800 million a year once that mine's on, relative to, they could do that now in a really high price environment, but in a lower price environment, they're more like half that. So it's a big change for them. And it's one that's really needed. In my view, the growth versus buyback they're kind of just different sides of the same coin, really.
So I was talking to this was a cable company, but I would always bang them and I'd say, hey guys, like rough numbers, your stock trades for $2,000 a home pass and you're building out homes at $2,500 per home pass. And I'd be tearing my hair out. You need to be buying back stock. And they one time somebody sent me and I was like, look, I hear what you're saying. Okay. But do you think that these homes we're building at $25 per home pass are attractive returns? It'd be like, yeah, sure. And you and we're on the same page, right? The high teens, low 20% IRR, cost of capital is obviously equity is a component of cost, but yes, anybody would like a high teens, 20% return. Like, all right, game this out. We cannot stop building this week to buy back stock and then start building next week because our stock's gone from 2,000 homes passed to 3,000 home pass. So it makes more sense. We have to decide on a 5-year view, does this make sense? Commit to it and go through it. Now, that doesn't mean if we got into distress, we couldn't stop, but we can't just stop and start. And for Warrior Met Coal, I've come to kind of see the same thing, right? They say, hey, this is a great project. You can tell me what return on investment you think they're going to get. Let's say it's 20%. That actually might be a little low for a coal company on their cost of capital, but it's a great project. We can't, because our stock goes from 70 to 50, stop this project for 2 months and buy back stock. We just have to say, is this a good project or not, and build it. And obviously, if our stock was 2, maybe it's a different component, but we've got to build it. So I wouldn't, anything you want to add there, or I kind of hopped on a soapbox?
Yeah, it's okay. I mean, the way I kind of view HCC is like future AMR. Like they're building a project now that's going to take them up to, kind of around that same level of production. And then they're going to have all this free cash flow and nothing left to do with it. So, I don't think the value of Blue Creek is fully appreciated into Warrior share price yet. And, certainly it hasn't been rewarded with, the same sort of multiple upgrade because it hasn't been in the market, participating in buybacks the way that AMR has. That's really the only difference in my mind. And that's why I was trying to say, like, the valuation is kind of arbitrary. Like the market's only given these companies credit for like 3 years of production when they have 20 or 30 left. So if we're, if we're mining these out to terminal value, then you're buying it for 3 years. You're buying it at 1/10 of what it's worth, really, to you over the longer term. And that's kind of how I think people sort of need to think about it, more so than what's the multiple or what's the valuation or whatever. It's driven by 2 things. It's driven by what percentage of free cash flow can you generate, and what's the denominator. What are you dividing that? And if you can continue to reduce that denominator, that multiple is going to go up and up and up.
Buying back shares at 4 times free cash flow is a hell of a drug. We're in an election year. Obviously, we talked a little bit about Biden administration doesn't like coal. They might be doing it for a little bit of points. Do you, Trump administration, Biden administration, third-party administration, obviously it changes how the regulatory response. Do you think it matters for the investment case? Like, I could imagine you tell me, hey, Biden administration would be better because it continues to discourage capital in these guys so they get sustained price power. I could imagine you saying, hey, Trump administration will be better because he's going to roll back all the regulations and taxes are going to end. Does it matter? How do you think about that?
I asked a good friend in the industry that exact same question, a while ago at dinner. And, the response from them was because, keep in mind that they're closer to the front lines, than we are. And the one thing he said about a Trump win was it would really galvanize morale because guys are not going to worry for their jobs like they would otherwise. And that's meaningful, that really, really is. Me thinking, in terms of second and third order effects is that, I'm thinking, well, the energy transition and democratic policies have been amazing for coal investors because they don't necessarily understand what it is that they're legislating and how they're bringing about or what kind of transition they're bringing about and at what pace. So as long as they continue to ignore the pacing of the transition in general, commodity prices, not just coal, but commodity prices in general are going to be crazy.
I'm laughing because every time Donald Trump gets up and say, we're going to drill, baby, drill. I'm sure if you're a energy employee, especially on the front lines, you're happy about it, job security. But as an energy investor, I like crying. So I'm like, no more drilling, please. God, no.
That's right. And so I don't really view either one as particularly bad or particularly good. But my sort of sense with the Democrats is they'll say one thing, but then the goalposts are just going to get, pushed out the closer they come to realize, like, well, we're not going to meet. You know what I mean?
you just run into a physics hurdle, right? Like, unfortunately, these energy investments, it takes a long time. These are really complicated systems, and it sounds great, but I've spent a lot of time with airlines, and yeah, it sounds great. Let's decarbonize the industry. You can't fly a plane on a battery, unfortunately. It just takes a really long time. I just want to come back. Last question on Warrior Met Coal, right? You and I are talking, stock is around $54 per share. I realize it's really hard to ascribe a fair value to something where Blue Creek's coming online. We don't know if met coal is going to, trade 200 per ton or 500 per ton next year. I realize it's hard, but when a fundamental investor is looking at this, like, just give a range of what a fair value you think were met coal, where you'd be like, I'd be neutral to owning this versus the index or something else.
So the way I kind of think about that is, I think that the companies that have growth projects coming on are probably doubles or doubles-ish from here. I think Warrior should probably trade at about 120. Can you
just give me a little bit of background?
Needs to relate higher up into mid twos.
Just give me a little bit. Why Warrior 120? Like, what forms that in your mental model? Why do you think 120?
All right, I do need one data point if you don't mind looking it up, because my internet's been unstable here. What's the current share count of Warrior?
Warrior has per share 52 million shares.
Okay, so 52 million shares versus Alpha's at 12.9, right? So
I believe that's correct.
Right. So at 800, basically at 800 million per year of profit, they'll kind of wind up being the same sort of level. BTU as well. So now really the only difference is whatever the denominator is. So in my mind, they're similar enough that should sort of be what the comp is. So, I guess Alpha's stock, Alpha has what? It's 13 divided by 52.
Call it 4 times. Alpha's got a fourth of the shares outstanding. Yeah, I think that math is perfect, actually.
Yeah. So if Warrior were to double in value, and then they were to buy back, 75% of their shares, theoretically they should be right around the same level as where Alpha's is, right?
So if I could what I heard from you is, hey, I think both Warrior and Alpha on a kind of mid-cyclish number would do about 800 million in, I think that was free cash flow per year is kind of what you're saying. And obviously that would take Warrior bringing Blue Creek on, I believe, but that's kind of the number that I'm hearing from you, 800 million.
Yeah. And let me make sure that's the case. I'm just going to open up my model for each of them.
Great. And as you say that, I'll just, so 800 million divided by Warrior 52. So you're saying, hey, Warrior's at 50, the low 50s, they're trading for under 4 times free cash flow. AMR at 800 divided by 13. I'm sure listeners love hearing math. At 300, they're trading for about 6 times free cash flow, 5 times free cash flow. So
yeah,
go ahead.
EBITDA, sorry. EBITDA.
That's EBITDA. So actually there is some CapEx, but it's still quite low. Maybe we'll call it 5 times free cash flow for Warrior, 6 times for Alpha. And the question there is just, hey, do you want Warrior with, you get a 1-turnish discount? They're not quite to the share buybacks yet, but you've got Blue Creek coming online, which can kind of juice this and gives them a little bit, maybe longer runway. Or do you want Alpha, which, yeah, the stock is up a ton, but guess what? They're buying back shares. They're going to keep buying back shares. And you get that sweet, we are the largest player. We are the player everyone invests in. You get that sweet kind of momentum flow going. Am I kind of thinking about that correctly?
Yeah, that's right. So, for each of them, for 2024, I have Alpha at about 800 million in EBITDA, and I have Warrior at about 800 million in EBITDA. We're going to get a little Blue Creek here at the end of the year. Warrior has a higher percentage of low volatile coal, and they have lower costs because they're closer to the port. That's really the only difference. Like the revenues are going to be pretty similar at those levels. The costs for Alpha are going to be a little bit higher, but they produce a little bit more tons. By the time you get to Blue Creek, and there will be some changes, I think, in Alpha's product mix at that point in time. but they're just going to look really similar. So really, the only difference at that point is what's the share count, and that could be, let's say AMR by 2027, AMR will probably buy back another 25% of its equity, which would bring him to 10 million shares, and Warrior will be at 10 million, 9 million shares, and Warrior will still be at 50 something with the same amount of EBITDA. So
the cheapo in me loves the Warrior story, because every shareholder I talk again wants to take the proverbial shotgun and just be like, buy the shares back, stop these mini special dividends, buy the shares back. And I love having that story on the comm, especially with Blue Creek, which, the people I talk to, you and several others, think it's going to be a fantastic project. And I love that. But the experience of me has taught, hey, the larger player who's already down the runway of just retiring, the famous, what happens when you retire the last share, the player that's there, even if you pay up a multiple or two for him, it kind of does tend to work out better. So I'm just having the value investors pay as cheap as you can for the good news on the come versus, hey, you've already got the story. Sure, the stock is up literally 35 times over the past 4 years, but there's a lot more to come because they've got the cash flow, and they've kind of just strapped themselves to the wheel of the cash comes in and out it goes to the shareholders. So yeah, Matt, this has been fantastic. I know you have a hard stop. We've gone way over an hour.
Yeah.
Any last thoughts you want to wrap up with?
No, I mean, if you understand that, Met's probably better than thermal for the next couple of years, if you understand that, if you're a U.S. based investor and you're not owning foreign equities, then it's probably like AMR and HCC, as your first two barbells, and then, probably Arch and BTU are your next two after that. You've got most of what you need out of our conversation. With the others. Yeah, I mean, aside, and if you want broad exposure, there's an ETF now that we have access to. That needs liquidity and is creating shares, and it's structured in a way that is sort of 50-50. And so the way that I view like my portfolio is like the range index is what we want to beat, to generate alpha over the rest of the sector. The way that I think you do that is just leverage more met coal than thermal, since the index is 50-50, and you're going to be most of the way there. But those are the companies that we want to look at here for good entries over the foreseeable future. But you can just also, I mean, I buy it in my 401k, so I make little purchases, every time I get paid, and I'm dollar cost averaging in over time, and I don't really care at this point. It mattered to me when we got that big rate, and then we had a 6 months worth of volatility, like where I turned into a pretty much a degenerate trader at that point. But since then, since we've gotten this new sort of cycle up, and there's been some difficulties in the thermal coal market, I really sort of pulled back more to the investor side and just said, what, we're good. I'm good with this positioning, and we're just going to add to it over time, proportionally to the rest of the portfolio, and sort of leave it at that. But it's the bottom line is it's not our grandpa's coal industry anymore. The management takes these growth projects and the buybacks really seriously. They want to keep their labor, so they're going to have to pay them. The cost curve is supportive of higher prices, and also I think these last few years have kind of injected a jolt of life into the sector that I haven't really seen in my career, and it's nice to see these guys who are traditionally close to the vest kind of open up and welcome in retail investors, which you've never really had before. So it's just, there's a lot of exciting things about it, and all of us on Coal Twitter try to be friendly and approachable. And as always, if you have any questions about anything, your followers are welcome to just reach out and ask us directly on Twitter, because we love talking about this stuff, and we can do it clearly all day if needed.
No, again, and you can tell it's a great place. Unlike some of the other places, I haven't seen cold Twitter get too toxic, which is fantastic. And as you said, it's a really nice place, and they're open, and they're like, hey, 4 times EBITDA with the buybacks. The water's warm. Whoever wants to come on in. But Matt, this has been fantastic. As you can tell, we had a lot to talk about, and we could probably have gone for a lot more longer. So we'll have to have you back on for a follow-up, but really appreciate you coming on. Matt Warder, thanks to Range Resources Coal ETF for putting us in touch and getting us out there, and we'll chat soon. A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.